Hey everyone, welcome back to the channel. When the world's stock markets go into epic turmoil, you'll hear investors shouting buy the dip left and right, but this crash is probably just the tip of the iceberg. Panic selling isn't over yet, and even if you think you've snagged stocks at rock bottom prices, you might still be miles away from the true bottom. In this brutal capital game, the balance between buyers and sellers is long gone. Retail investors scrambling for cash get forced into cliff price deals, while the cash-rich titans of finance watch with cold eyes, waiting to scoop up shares even cheaper. What looks like a chaotic meltdown is actually the opening act of a massive, systematic wealth transfer. Today, let's dive into the real game behind the global stock market crash and wealth transfer, and explore the once-in-a-lifetime bottom fishing opportunity ordinary people might never see again. The crash's end is really the start of the bottom fishing loop. Market lows never happen when everyone's partying. They happen in moments of total despair, when even non-investors feel the sting and assets seem almost free. That's when liquidity dries up and policy moves turn into a grand harvest. Remember 2008? Lehman Brothers' collapse sparked a global financial tsunami. The Dow plunged 54% and millions of families saw their wealth evaporate. Yet firms like Goldman Sachs and JP Morgan not only walked away unscathed but bought distressed real estate and bad loans at pennies on the dollar, then rode those assets to exponential gains. History shows us crises are the best windows for financial giants to redraw the wealth map. Fast forward today, and Buffett's playbook reads like a classic case study. Back in 2023, he was dialing back U.S. stock holdings, hoarding cash, even selling Apple shares against the Trump-fueled market frenzy. He foresaw the U.S.-China tariff war and knew Apple, with its China-dependent supply chain, would bear the brunt. Add a 20% tariff and the iPhone's costs and pricing model get turned upside down. Sure enough, when tariffs hit, Apple's stock tanked 35% and Buffett was already out the door. Similar moves popped up from Gates and Zuckerberg, too. Microsoft trimming tech bets for farmland and renewables, Meta buying back stock and spinning off divisions to dodge policy risk. Their playbook is clear: offload volatile assets onto latecomer retail investors and lock in long-term gains in anti-cycle sectors. The tariff war, a targeted blast to global wealth with boomerang traps. On the surface, tariffs beat trade deficits, but really they're about draining dollar liquidity and triggering asset price crashes. It's bleed economics. Hike import costs to force factories back to U.S. soil and squeeze emerging markets' forex reserves. Europe's car industry got hit hard. After the U.S. slapped a 25% auto tariff on the EU, Volkswagen moved some plants to Tennessee but saw per-car profits drop 12% thanks to higher labor and supply costs. Meanwhile, Mexico's peso plunged 15% as export revenues collapsed and foreign investors panicked, wiping 23% off its stock market in just 1 month. This America First move may boost U.S. manufacturing on paper, but it tears global supply chains apart and eventually hits consumers hardest. After tariffs went up, living costs for low and middle-income U.S. families spiked 8.3%, and companies cut worker benefits to protect profit margins, kicking off inflation, job loss, shrinking spending, death spiral. Even worse, the policy is boomeranging back on the U.S. itself. The triple whammy of tumbling stocks, weakening dollar, and wobbling treasuries is exposing a fatal flaw. The government treats the stock market like an ATM, and now confidence is collapsing. In late 2023, demand for new 10-year Treasury auctions hit record lows, with Japan and China slashing holdings by 14% and 9% respectively, forcing the Fed to buy 40% of fresh issuance. Print money with one hand, buy bonds with the other may stabilize rates, but it further erodes dollar credibility. BIS data shows the dollar's share of global FX reserves fell from 66% in 2015 to 58% in 2023, while gold and the yuan keep climbing. The liquidity crisis is the death spiral of leverage bubbles and margin calls. Modern markets bleed under excessive leverage. In 2023, U.S. margin debt topped $1.2 trillion as investors pledged stocks to borrow more, creating a feedback loop that rockets prices up and obliterates them on the way down. Say you buy $100 of a tech stock, it doubles, you borrow $150 against it to double down, then a tariff shock knocks it down 30% to $140. The bank slaps you with a margin call, no extra funds, and your position is liquidated. Multiply that by millions and you get cascading sell-offs, then price drops, more margin calls, and then bigger sell-offs. In March 2024, the Nasdaq plunged 12% in a week. Over $200 billion in leveraged bets got auto-liquidated and dragged down Bitcoin, oil, and other linked assets by half. To cover debts, investors dump everything, draining global liquidity. The IMF warns non-US dollar-denominated debts now exceed $25 trillion. When dollar liquidity tightens, emerging markets face a triple shock of defaults, capital flight, and currency crashes. Argentina's peso tumbled 40% in Q1 2024, its FX reserves nearly gone in this playbook's dress rehearsal. The Fed seems to have a clear rescue plan, but it's tangled in conflicting interests. Gradual balance sheet expansion, keep rates high but inject liquidity through targeted tools. This can contain inflation but won't stop the sell-off in April 2024. A $500 billion repo plan barely lifted the S&P 500, which plunged again 3 days later. Unlimited QE 2.0 repeat 2008 zero rate, unlimited bond buying. That could stabilize markets fast but shower capitalists with more wealth. Goldman predicts a fresh QE would boost the top 1% assets by $7 trillion while shrinking the bottom 50%'s real income by 2.3%. The deeper issue is the Fed isn't really independent anymore. In a 2023 hearing, Chair Powell admitted monetary policy must back fiscal expansion. Basically, the Fed is the debt backstop for Congress. That political economic knot is draining dollar credibility. If U.S. debt tops $40 trillion, Goldman warns the dollar could lose its reserve status and unleash a de-dollarization tsunami. Wild swings show asset prices are pawns in policy battles. One Trump tweet can shake the Dow by 1,000 points, while insider trading records show Congress members sold record amounts of stock a month before the crash. For everyday folks, the mission isn't nailing the bottom, it's preserving purchasing power. Snag inflation hedging physical assets like gold's continued rise and silver, up 35% thanks to industrial demand. Hedge with safe haven currencies like the yen and franc, but treat crypto as high volatility speculation. History proves every crisis spawns new winners. Rockefeller built his oil empire after the 1929 crash, Amazon and Google rose from the dot-com bust, and Tesla's market cap exploded tenfold post-20 pandemic. Today's darkest hour might hide the next disruptor. Global order reboot and the darkness before dawn. America's tariff gambit to fend off crisis is showing cracks as China and Japan dump treasuries and capital flees U.S. soil. When safe stocks prop up the dollar and backstop bonds becomes an impossible trinity, systemic collapse could light the fuse for a new world order. For investors, real opportunity may arrive the moment the Fed unleashes the printing press. Until then, keep cash flowing, steer clear of high leverage plays, and stay wary of policy black boxes. In this capital game, staying alive beats getting rich. Only those left at the table get to play the next hand. So when is the best time for us to buy the dip? Well, first off, it's not now. Right now, the stock market and asset prices are swinging wildly just because of a single word from the government. If you jump in now, chances are you won't make much, and worse, you could lose it all just as fast. That's why, at this stage, we wait. We stay patient. And when the Fed finally turns the money printers back on, that's our cue. That's when we follow the big players and start buying in slowly. That's our direction. That's our game plan. Back in 2008, I wasn't in a position to do anything. But this time maybe, just maybe, it's our shot. Alright, this video reflects personal opinions only and does not constitute financial or investment advice. If you got value from this video, hit that like button, subscribe, and ring the bell so you never miss an episode. Drop your thoughts in the comments. What's your game plan for the next big move? Thanks for watching, and I'll see you in the next one.